A lot of times when people come to a planner, it's to make sure that their loved one is well taken care of after they're gone. And while yes, it's really important to plan while both generations are living, it usually begins with what happens when something happens to me. And this is one reason to create a special needs trust. But how exactly should we fund that trust? Now, this is a really big concern because if you use your retirement assets, a lot of times between retirement and long-term care, those are mostly depleted by the end of your life. This is where life insurance can be a really great tool to fund a special needs trust so that you're able to use your retirement dollars that you've been saving for your retirement and your long-term care and use the insurance money to fund the special needs trust once you're gone. Life insurance provides the unique opportunity to be able to guarantee financial security without having to put the burden on other family members or loved ones. Hi, my name is Elizabeth Larson. For all the best information on special needs planning, make sure that you hit that subscribe button and that notification bell to make sure that you're alerted every time that I post new videos. Now, there are so many different types of life insurance, it can kind of get overwhelming. There's term life insurance, permanent life insurance, universal life insurance. The list goes on, and that's not even including the riders that you can add on to each of these. Now, people purchase life insurance for a variety of reasons. It could be to support their family members after they've passed away. It could be to pay off debts or other expenses like burial or funeral expenses. It could be to leave an inheritance. And today we're going to be talking about leaving an inheritance inside of a special needs trust to make sure that their loved one is well taken care of after they've passed away. Okay, so first let's go over what some of these types of insurance are. First, there's term life insurance, which is probably the easiest to understand. And what this is, it's an insurance policy where the insured is covered for a certain amount of money for a certain amount of time. Now, because this insurance does lapse at some point, it usually offers the highest death benefit for the lowest amount of money in the beginning years. Now, this does not mean that it is the cheapest for the duration of the time that you need the coverage, because every time that you need to renew your term insurance, the premiums are going to go up, and it could be well over the amount, in your later years, it could be well over the amount that you would have paid had you had level whole life insurance from the start. Now, term insurance it covers you for a certain period of time, where whole life insurance, it covers you for your entire life and then pays a death benefit at the time of your passing to your beneficiaries. So as long as you keep paying your premiums for your whole life, your beneficiaries will receive the benefit upon your passing. The great thing about whole life is that it also builds up a cash value over time, tax deferred. Now, there are a few different types of whole life insurance. First, there's ordinary whole life insurance, and that's where you have a level premium throughout your entire life. And then there's limited pay, and that's where you can pay your premiums over a certain amount of time, say for 20 years or so. And then once you're done paying those 20 payments, then you're covered for the rest of your life and you don't have to make any more premium payments. And then there is single pay, and that's where you just pay one big lump sum of money to the insurance company, and then you're covered for the rest of your life. And then there's second to die or survivorship life insurance, and that's where two people are insured, and the benefit is only paid after the second person passes away. All right, so then there's universal life insurance, and this is where your premiums and the death benefit can kind of vary depending on your circumstance. You can build up your death benefit if you need more, or you can skip payments if you have enough money in your account. Now, it's important to make sure that you're always up to date on what's in your account so that you don't accidentally skip a premium payment and then make it so that your insurance policy is no longer in force. All right, so the last one we're going to talk about is variable universal life insurance. And this is where your life insurance cash value and death benefit are all based on an investment account. So if the account is doing really well and it's going up, your death benefit and your cash value are going to go up. And vice versa, if the account is going down, then your death benefit and the cash value will also go down. Now, to find out what insurance is best for you, you need to make sure that you speak to somebody who has specialized knowledge in insurance, because there is not like one best kind of insurance. Everybody has a different situation, meaning that they have to have different insurances so that they can achieve their different goals. Now, when it comes to funding a special needs trust, there are some things you need to consider. When in regards to term insurance, it might look desirable because the premiums are lower, but they're not a great option because say that the term insurance lapses and then you pass away, you end up leaving that special needs trust unfunded. And then even if you want to go and renew your term life insurance after it has lapsed, the premiums are going to most likely be pretty expensive, and for some people wouldn't even be able to pay those premiums. Because of those two reasons, a whole life insurance policy might be a better option. And this is where you can decide whether you want to pay level throughout your entire life, level premiums, or you can pay over a certain period of time, or you can pay in one lump sum installment. Now, an important type of insurance that a lot of families use to fund special needs trusts is the survivorship or second to die policy. And this is because since the insurance policy is covering two individuals, the premiums are normally lower and it usually has a more lenient underwriting process. Second to die policies are really great for people who are solely looking to leave an inheritance or for they also use it for a good estate planning tool. Now, it's really important to remember that premium payments still continue after that first individual dies. And so you need to make sure that if you do choose to get a second to die policy, that those premiums aren't going to put a real financial strain on that second individual who's still living. I hope that you found this information to be helpful. And while funding a special needs trust with life insurance might be the best option for some families, every family is different. So you need to make sure that you're speaking to someone who has specialized knowledge in the area of special needs planning for your individual approach. Now, if you like this information, make sure that you hit that subscribe button and that notification bell to make sure that you're alerted every time that I post new videos, and share it with a friend. And if you really liked what you heard today, make sure that you click on that link below to become a client so that we can start putting together your overarching financial strategy with your special needs plan. Because remember, planning for your loved one's future today makes for a confident tomorrow.